Hello, and welcome back to another series of short videos. In this series of videos, we're going to be discussing Chapter 15, which deals with partnerships, specifically termination and liquidation of partnerships. So we're going to work on a problem here. It's going to be problem 15-4. And if you look at the screen here, it's up on the screen. Basically, this problem, what they want us to do is to prepare a statement of partnership liquidation to determine the amount of cash that Bell would receive from the sale of the partnership assets. So what happened here is we have a partnership, and they're considering possible liquidation because one of the partners, well, they're personally insolvent, okay? So what we have here is we have the four partners. We have their capital balance accounts, and we have their profit and loss ratio, okay, of how they're going to split the profits and the losses. So they tell us that Bell's creditor have filed a $21,000 claim against the partnership's assets. Okay, so because he's insolvent, because he owes somebody money, personally he owes somebody money, that person that Bell owes money to, he's coming after, or he or she's coming after the partnership. Okay, so they tell us that the partnership currently holds assets of $300,000, liabilities of $100,000, and they tell us that an independent appraiser indicates that the assets can be sold for $90,000. Okay, so what I did already was kind of created a spreadsheet, if you will. Incidentally, this is identical, or should be pretty much identical to, I believe it's Exhibit 15-4 in the book, I believe, when they show you how to prepare a partnership or statement of partnership liquidity. Okay, so the first thing I did was just plugged in my balances. Okay, they got $300,000 in assets, $100,000 in liabilities. I plugged in the capital accounts for Bell, Hardy, Denard, and Sadath. Okay, so the first thing, and remember, like our authors talked about, whenever we're trying to liquidate a partnership, first thing we got to do is sell all the non-cash assets, pay our liabilities, and then if there's any cash left over, then we can go ahead and distribute that cash. Now, I did leave out a few steps because we're going to do those steps as we go through this problem, right? So first thing they tell us is we sold the assets, okay? And in the problem, they told us that we sold the assets for $190,000. Okay, so what I'm going to do is I'm going to go ahead and say, okay, well, we sold the assets. Minus 300,000. Minus 300,000. And because we sold those assets, we got cash. Specifically, we got $190,000. Right? We're just going to use the appraiser's valuation. Now, remember, first thing we got to do, sell all the non-cash assets, which we just did here, and then any gain or loss gets allocated to the partners, okay? So, let's figure out how are we going to do this, right? Well, first thing is we have to figure out what is our loss. Well, they were valued at $300,000, the assets. We got $190,000 for them. So the difference between these two bear with me here. Why is this thing running slow? Okay. So what we want to do is we just want to take the difference between the two. So we get a negative 110,000, right? So this loss from selling the assets, we need to allocate that. How are we going to do that? Well, we're going to allocate it based on their capital or profit and loss agreed upon ratios. So I'm going to take the $110,000 loss, and I'm going to apply 40% of that to Bell. Of course, 40%. Why? Because that's part of their split, right? Now we move on to Hardy. We're going to do the same thing. We're going to take the loss of $110,000 and multiply that by the ratio that he's going to share, which is 30%. So I'll multiply it by 0.3. Denard, same thing, right? We're going to allocate that $110,000 loss from selling the assets, and we're going to multiply it by 0.2 or 20%. Why? Well, because that's Denard's agreed upon split. And then finally, Sadath, we're going to multiply the loss of $110,000 by his percentage, which is 10%. We get $11,000. So now what we're going to do is we're going to go ahead and say, okay, what's our subtotal, right? We're going to calculate our subtotal. So basically all I'm doing, try not to get too concerned with what's going on in Excel. All I'm doing is just calculating, well, what's the total, right? Look at Bell now. Look at his capital account. It's now at $6,000. Why? Well, because he had $50,000. He gets 40% of the loss. That's $44,000. That only leaves him with $6,000. Okay. So now the next thing we're going to do is we're going to pay our liabilities, right? Now, what do we know about our liabilities? Well, we owe $100,000. We're going to pay $100,000. We have enough to pay. So to pay the liabilities, I'm going to deduct $100,000 from cash, and I'm going to show that my liabilities are also going down by $100,000. Okay, and then the next thing I'm going to do is recalculate my subtotal. So we can see then, after we pay the liabilities, we have $90,000 in cash. We have $6,000, or Bell has $6,000 in his capital account. Hardy has $23,000, and then Denard, has a deficit $8,000. Okay. Well, in the problem, they didn't tell us that he was going to, Bell's going to contribute money to get rid of that capital balance. Nothing like that. So what we need to do now is we need to allocate that deficit. Okay. We need to take the $8,000 of Denard and allocate it to Bell, Hardy, and Sadath. The problem is, how are we going to allocate it? Okay. Well, we know the amount to be allocated is going to be $8,000, and we need to allocate it to Bell, Hardy, and Sadath. So what I'm going to do is I'm going to come over here, and I'm going to recalculate their ratios. Okay. So we have Bell, we have Hardy, and we have Sadath. Okay, so think about it. Denard drops out, right? Poor Denard has a deficit. It's getting allocated to the rest of the partners, and Denard gets no cash. He's done. Okay, after we allocate this loss. So notice what we have. We have 40% for Bell, 30% for Hardy, and then 10% for Sadath, right? So all we need to do to figure out what their rate is we need to take the 40% that they agreed upon for Bell and divide it not by the full amount, the 100%, because we can't, because Denard's 20%, he's gone. Okay, he's not getting any cash. So we're going to do 40 over 80 for Bell. For Hardy, we're going to do the same thing. We're going to go 30 over 80. And for Sadath, we're going to take basically 1/8 of the law, or of the deficit, which ends up being, bear with me here, ends up being 10 over 80. Okay? So now what I'm going to do is I'm going to go ahead and allocate that deficit, right? This 8,000, negative 8,000, is going to get allocated 50% to Hardy. Why 50%? Because it's 40 over 80. For Hardy, Hardy gets 3/8 of the deficit. Crap. Sorry about that. Let's just do 30 over 80. There we go. So Hardy gets 3,000 of Denard's deficit, and Sadath, well, Sadath gets 1/8 of it, which ends up being $8,000. Sorry that didn't work. I'm trying to get cute here with Excel. So it'll be 1/8, and we get $1,000. So now we can recalculate the subtotal, right? Well, we now have 90,000 in cash still. Didn't do anything with it yet. Now remember, bear with me here for 1 second. Remember, how much cash does each person get? Right? Well, they get the amount enough to pay for their, or I'm sorry, let me rephrase that. The final cash is distributed based on the final balance of the capital accounts. So the question originally asked us, how much does Bell get? Well, Bell only gets $2,000 in cash, okay? That's all he would have available to pay his creditor, okay? Hardy gets $20,000 in cash, and Sadath gets 68,000 in cash, okay? So that, my friends, is how you put together a statement of, partnership statement of liquidity, okay? So thanks for tuning in, and come on back, and we'll work on another exercise and see how we continue to handle deficits. So please tune back in for that one.